Question 41. You've been given the following information regarding a stock index. So we've got current index level, risk-free rate, and dividend yield. What is the futures price for a 6-month contract on the index, assuming continuous compounding? So this is going to be pretty straightforward. We're given all the information we need to solve for this. We're just going to need to plug and play, and we need to make sure we commit this formula to memory. So our futures price is going to be equal to that spot price or the current price, which will be our 1120. And then we're going to compound that continuously per the question. And then our R minus Q. So our R is going to be the risk-free rate, and then that Q is going to be the dividend yield. So we need to subtract that out. And then our T is going to be adjusting that for the number of years. So we've got, these are annualized numbers, but since we're only looking at a 6-month contract, our T will be 0.5. So we're going to have the 0.06 minus 0.02 times 0.5, and then we're going to raise that to the continuously compounded variable, and then multiply that by 1120 to get 1142.63, which corresponds right here with answer A. Question 42. A bank only uses VAR to measure the risk in its trading book. The bank has a 1-day VAR of USD 25 million at a confidence level of 99%. During the last 200 trading days, this VAR was exceeded only twice, with total losses of USD 500 million and USD 200 million being incurred. According to the VAR measure on its own, the bank has been successful in managing its risk, but in reality, it has lost USD 700 million. In this scenario, the failure of risk management can most likely be attributed to. So we've got A, failure to use appropriate risk metrics. This sounds like it could be our answer right off the bat. The problem is we're only using one metric, which is VAR. So we're really only measuring how many trading days we have where we exceed this 25 million at 99% confidence level. And we only exceeded twice, which sounds pretty good. However, those losses are massive. We're well above this 25 million confidence level. So when we're incurring losses, 500 million and 200 million, those losses are what we would call a really far left tail losses. And so we're not utilizing any metric or measurement to kind of understand the magnitude of losses that's possible. So A sounds like it could be our answer. Let's make sure we can rule out the others though. B, mismeasurement of known risk. We're not mismeasuring the VAR. The problem is we're just not using anything else outside of that. So I think we can rule that out. C, failure to take known risks into account. I think you could argue these are not necessarily known risks. We don't know how deep that left tail is. So we could rule that out as well. And then failure in communicating risk to top management. They're communicating the risk, just not using the proper metrics. So I think we could stick with A as the best answer here. Question 43. You've been provided the following information. So we've got weighted long run variance, weighting on previous period's return, weighting on previous volatility estimate, daily volatility estimate, recent market return. And then using the GARCH 1-1 model, the volatility per day on N, standard deviation of N is closest to. So formula we're going to be using here, we're given all the variables here. So it's kind of a matter of just identifying where that we need to plug them in. So first variable is going to be right here, weighted long run variance, so 0.00001. And then we're adding that to this first coefficient is going to be our weighting on the previous volatility estimate. So this beta or this coefficient and then this coefficient here. So beta and alpha, these are going to be the weightings. So that first weighting is going to be 0.8. And then that second weighting right here is going to be 0.15. So we can see those corresponding down here. And then we've got standard deviation of N-1, so standard deviation of the prior period. So that's going to be the daily volatility estimate of 0.015 there. And then the U squared variable is going to be our recent market return. And so it's N-1 because it's in the past. So we're getting our daily volatility estimate from information in the past and the recent market return as well. So when we From here, I mean, it's really just a matter of memorizing this formula, and we're gonna work through this question or work through these numbers here, and we get 0.000205. However, we are given this formula is invariance, so we do need to take the square root of this in order to get our final answer. And so when we do that, we get our standard deviation of 1.432%, which is right there, answer C. Question 44, an analyst runs a multiple regression of a variable y on 4 independent variables for 50 observations. If the sum of the squared errors for the regression is 125 and the total sum of squares is 450, then what is the adjusted R squared for the regression? So to calculate adjusted R squared, we're first going to need to calculate R squared, and then we'll be able to calculate adjusted R squared from there. So let's walk through calculating both of those. So R squared, or coefficient of determination, that's going to be equal to our sum of squared errors for the regression. So we're given that right here at 125. And then it's going to be 1 minus sum of the squared regression over the total sum of the squares, which is also given at 450. So that's pretty straightforward. We get 1 minus 125 over 450, so 0.722. And we can see that is an answer given. So if we just if we would have just calculated R squared, we would have gotten that wrong and went with A. So then from here, we need to adjust that R squared. So here's the formula for adjusted R squared. It's going to be the 0.722 is going to be plugged in here at the end, 1 minus that. And then we need to multiply that by all these numbers over here. So that's going to work out to n, so number of observations, which we get at 50, n minus 1, so we'll have 49 up here, and then n minus k minus 1, which is going to be 50 minus 4 minus 1. And then we're going to multiply, it'll be 1 minus all of this multiplied together. And so when we work that out, we end up with 0.697, which corresponds right here with answer C. Question 45. The 2007-2008 financial crisis was primarily a result of 2 major risks. These are A, credit and liquidity risk, B, credit and market risk, C, liquidity and operational risk, or D, market and operational risk. So we've got 4 different risks here that we're looking to evaluate: credit, liquidity, market, and operational. And then so kind of some combination of these. So the 07-08 crisis was primarily driven by credit risk, 1. So that's going to be an A and B. So the credit risk came from a lot of the defaults on subprime mortgages that were being initiated throughout the mid-2000s. So we can rule out C and D. And then the second risk that came into place there, we're looking at liquidity or market risk. It came in the form of liquidity risk. And so the issue was so many banks were holding these subprime mortgages, and then when the defaults started happening, they had no one to kind of sell or trade them with. So the liquidity also caused those mortgage bonds to tank. So we can go ahead and rule out A, we rule out B, and we'll go with answer A, credit and liquidity risk for that, for the Great Financial Crisis. Question 46. An investor can immunize their portfolio against large parallel shifts in the zero curve by. So the term immunize essentially means make our portfolio not sensitive to it. So we want to essentially get rid of the risk related to interest rates, so large parallel shifts in the zero curve. So what do we need to do that? So we've got A, choosing a portfolio of assets and liabilities with a net duration of 1 and a net convexity of 0. So if we have a duration of 1, we are going to have some sensitivity to interest rate changes, so we won't be fully immunized. So we can go ahead and rule that out. B, choosing a portfolio of assets and liabilities with a net duration of 0. Okay, that sounds better. And a net convexity of 1. If we have convexity of 1, we're going to have interest rate sensitivity as well. So duration and convexity are both measures of interest rate sensitivity. Convexity measures that nonlinear portion. So if we have exposure there, we are still going to have sensitivity there. So I think we can rule that out. And it kind of tells us that we want to be looking for an answer where we have 0 for both of these. C, choosing a portfolio of assets and liabilities with a net duration of 0. Okay, that's good. And a net convexity of 0. Alrighty, based on what we talked about in A and B, sounds like this could be our answer. And then D, choosing a portfolio of assets and liabilities with a net duration of 1, no good, and net convexity of 1, also no good. So we'll go ahead and rule that out. Stick with answer C. Question 47. You've been given the following incomplete probability matrix about the return in foreign currency terms on an investment made in a foreign country as compared to the benchmark and the expected change in the exchange rate of the local currency against the foreign currency. So we've got 2 columns here, outperform or underperform, and then under these different scenarios. So whether we get currency appreciation, no change in depreciation. So what this table is kind of telling us is if we have appreciation, we have a 10% chance of outperforming and a 15% chance of underperforming. And these are this should all sum to 1. So this total over here should be 45. This should be 55. So we'd be able to fill in these numbers pretty quick. So then what is the unconditional probability that the investment will outperform the market? So unconditional probability is always going to be, should always sum to 1. So we can't outperform and underperform at the same time. We're either going to outperform or we're going to underperform. So the box we're looking to fill in right here is this one. So since our total chance of underperforming is 55%, that our probability has to sum to 1 overall. So this is going to be 1 minus 55%. So pretty straightforward. 1 minus 0.55 is going to be 0.45. Sorry, excuse me. Or 45%. So we will stick with answer A right here, 45%. Question 48. A 0 coupon bond has a face value of $5,000 and a maturity of 8 years. The 8-year yield rate is 6% compounded semi-annually. What is the value of the effective duration if the yield rate changes by 4 basis points? So our effective duration formula is going to be this right here. So P minus, so the price if the price change when yields decrease, and then minus the price change when yields increase. So essentially when those yields go up or down 4 basis points, that's what these values are going to yield. And then in the denominator, we've got 2 times the price at the start, and then multiply that by the change in yield. So this is going to be our 4 basis points plugged in right here. So all we're given is the face value, and we have maturity and the yield. So essentially we need to use our time value of money calculation on the calculator in order to go ahead and solve this problem. I'm not going to go through and punch in all of those numbers because that'd be pretty tedious, but here's the numbers for what you will need to plug in order to solve these. So I'll walk through this one, and then you'll be able to do this on your own and make the changes to do so. But so our PVO, so this is going to be the current price under these circumstances currently. So 5,000 face value, payment of 0 since it's a 0 coupon bond, and that's going to be static across all these that we're solving for. We're going to payment of 0 and face value is going to be the same. Our N is also going to be the same at 16 since we have an 8-year rate compounded semi-annually. And then the difference is going to come in where the interest rate changes. So for PV0, so price currently, we're going to be using 3%, which is our 6% divided by 2 since we're compounding semi-annually. So we're going to plug in all these numbers, and then that's going to give us our present value, and then we'll be plugging that number in right here. And then all we need to do is change the I value for PV minus and PV plus. So notice for the I value though, we're only changing it by 2 basis points since this is compounded semi-annually. So the PV minus rate would be 5.96. Since we're changing it by 4 basis points, divide that by 2 gives us 2.98. And then same thing you can see down here. Increasing by 4 basis points, we'd be at 6.04. Divide that by 2, we get 3.02. All right, so a lot there. But once we work through that, the values we end up getting. So when when the interest rates decrease, we get a value of just over 3,125. And then when interest rates increase, we get a value of just over 3,106. So that's going to be our numerator right here. And then we're going to divide that by 2 times the current price, which we plugged into the calculator, and we would get just over 3,115. And then we're going to multiply that by 0.0004 for our 4 basis point change. And that gives us 7.767 when we multiply that out. And when we round that up, we would get answer A. Question 49. Catherine Austin works at the arbitrage department of an investment bank. She finds that an asset is trading at 2,200 USD. The price of a 1-year futures contract on the asset is 22.44, and the price of a 2-year futures contract is 22.95. Assume that the asset exhibits no cash flows in the first 2 years. If the term structure of interest rates is flat at 2%, which of the following would be an appropriate arbitrage strategy? So we've got short the 2-year futures, borrow 2,200 USD at 2% and buy the underlying, buy the 2-year futures and short the underlying, short the 2-year future, borrow 2,200 at 2% and short the underlying, buy the 2-year future, borrow 2,200 at 2% and short the underlying asset. So it looks like we're going to be focusing on the 2-year futures here. So we kind of need to determine whether there is an arbitrage. So we're going to be looking at this 2-year futures contract, and then we're going to price it out using the interest rate and the current asset price. So we can price that out, and then we can figure out whether or not this futures contract is over or undervalued and whether there's an arbitrage opportunity. So I did this for the 1-year future and the 2-year future just to show it. But for the 1-year future, we get, we're going to do 2,200 times our continuously compounded risk-free rate at 2%, we get 22.44. So we can see that that is fairly valued, so there's no arbitrage opportunity there. And then for the 2-year price, we're doing 0.02 for 2 years, continuously compounded at, and we'll continuously compound that 2,200. So we get 22.89 as our fair value price here. So we can see there's a price discrepancy there of about $6 per contract. So essentially our model or our, we think the contract is only worth $22.89, but it's actually trading for $22.95. So we're going to want to short this futures contract and then be long the underlying. All right, so we've got A, short the futures contract. That sounds good so far. Let's just start with that for now. So that's good. We'll buy the underlying. We don't want to do that since that would be buying an overvalued asset. Short the underlying, that's good. And then D, buying the futures, not good. So we're down to A and C now. So the rest of this is borrow 2,200 USD, which we have here as well at 2%. And then we either want to buy the underlying or short the underlying. So by shorting the futures, we want the price to decrease, and we expect it to decrease based on our estimation and what they're currently trading at. And then if we short the underlying as well, though, we're basically then double short the asset. And so we can't be, it can't be an arbitrage or true arbitrage strategy if we're short in both directions. To make a risk-free profit, we would have to be short one and then long the other in order to hedge out those positions and make that $6 spread that we identified. So we're going to go ahead and rule out C since we'd be shorting both, and then we will stick with A, short the futures, and then borrow money to buy the underlying. Question 50. You've been given the following probabilities. So we've got probability of A given B happening is 25%. The probability of B given A happening is 50%. And then the probability of A is 30%. What is the probability of B? So for this question, we're going to be using, we can use Bayes' theorem on probabilities. And so what this is going to be is the probability of A given B equals the probability of B given A times probability of the probability of A, and then divided by the probability of B. So we're given this this and this, we need to solve for probability of B though. So essentially what we're going to do is just plug in the numbers, and then we'll be able to do some algebra and kind of work that out. So when we rearrange these, the probability of these two variables essentially just kind of get flip-flopped, and then we can plug those numbers in. So we'll have 0.5 for probability of B given A, corresponds there. Probability of A is 30%, corresponds right there. And then probability of A given B is now in our denominator, which is going to be 0.25 right there. And that works out to 0.6, which corresponds with 60%, answer A.